In this video, I'll be taking you through how to use various indicators, and the first one that we are about to look at is stochastic oscillator. So let's look at how to use stochastic to trade effectively. Stochastic as an indicator has three main important things that we need to know and understand, and that is: number one, to determine where the trend is going; number two, to determine if the price of the instrument or the currency pair or the security is overbought or oversold; and three, to determine if the trend will continue. So let's first look at how to get the stochastic onto the platform. All indicators are found on this page, insert. Okay, so insert, we go to indicators, and stochastic is actually an oscillator. So we come to oscillators, and then we look for stochastic oscillator here, and then we click, and let's use the default parameters: the K period 5, the slowing 3, the D period also 3, and let's use the MA method simple, and the fixed minimum 0 and the fixed maximum 100. And then once all these things are here, and the price field should be low or high, once all these things are here, we click on OK, and here we are. You can see it here. This is stochastic. So these two lines here is what is representing the stochastic. Alright, so let us look at how its settings are and how best it is used for trading. This is the main stochastic, that is the value. This line shows the value, and this broken line, of course, you can actually change it to be a real line like the value line, but on default this is how it looks like. So this is the signal, trend, and this is the stochastic value trend. Alright, so now this is how it works. You find out that stochastic is scaled from 0 to 100. You can see here it's scaled from 0 to 100. So these are its division: from 0 to 20, 20 to 80, 80 to 100. Now this is how it works when the stochastic line, this two lines. When these are the stochastic lines, these two lines. When the stochastic lines are above 80, this 80, then it indicates that the market is overbought. For example, here, when the line crossed and is above this 80 line here, you know, from here it went up and it crossed. Immediately it crossed here, this 80 line, and it's here. It means that the price has been overbought. On the other hand, when the stochastic lines are below 20, this 20, say here, for example here, when it got here, it means that the market price of the currency pair or the instrument is oversold. So these two things are the main things that we have to pay attention to. Stochastic scale from 0 to 100. When the value line, this value line and the signal, they move together. When they cross and they are above this line, this is the 80 line, this horizontal line here. So when the stochastic lines cross it, it means that market is overbought. The price has been overbought. So the price is high now. Then on the other hand, when stochastic crosses, when these lines, for example, let's look at here, when these lines cross and they are below 20, then it means that the price has been oversold. Okay, these are the two things that we have to keep in mind. What does these two things mean to us as traders? Good. We buy when the market is oversold. Okay, when market is oversold, for example, when the stochastic lines crossed the 20 and is below, it indicates a reversal is coming. So for us to place trades, we buy. From here we buy, we don't sell. So we begin to find an entry point here, so we buy. Then when market is overbought, for example, when market is overbought, which means that the stochastic line have crossed so that they are above the 80, it indicates that a reversal will soon happen. And so what we do is to sell. What we do is to sell. So when the stochastic lines move above 80, it becomes a ready to sell signal. Therefore, you may place your trade in wait for the sell, or wait when the stochastic lines cross below the 80. then you place the sell trade. For example, when they cross below this 80, then you can place the sell. On the other hand, when the stochastic lines cross below 20, okay, then you may place a buy trade, or wait once it cross above 20, you place the buy trade and leave it to run. So when it cross, so that is above this 20, then you place the buy and then you leave it to run till here. Alright, when stochastic line cross above 80, for example here, it can stay there for long, even meeting 100 before coming down. For example, if you look at this, you'll find out that it was approaching 100. Sometimes it can stay here for long. It can stay for long before making a reversal. So it's important that you have to be careful to check with other indicators before entering a trade. Likewise, when the lines cross so that they are below at the 20, they can stay for long before they reverse upward. So it's always important to make sure that they at least make a reversal a bit before you enter, if you want to use them as your entry signal. Stochastic works same in all the time frames. If we go to 4 hour, you'll see that it works the same way. It comes to 80, it shows overbought, then it goes down, and here it goes above 80, showing overbought. It stayed there for a while, and then it dropped. It couldn't touch the 20. It goes, and so you'll find out that stochastic works the same way in all the time frames. If we come to 1 hour, it works the same way. If we go to 30 minutes, it works the same way. But the best and stable time frame that stochastic works is the 4 hour time frame and the daily time frame. But 4 hour is mostly the best. So it's important that you always use other indicators to confirm with the stochastic indicator. The most important thing to note about stochastic is when the price is overbought, that is when the price moves above 80, or oversold, that is when the price moves below 20, it becomes more expensive in terms of spread for a trader. Meaning when you enter a trade, you will be entering at a higher rate. So it's always best to make sure that you confirm the stochastic with other indicators before entering the market. Basically, stochastic shows us that people or traders may leave a particular position. For example, for when market is overbought, it's simply an indication that buyers are leaving or have left the market and only few buyers are left, and same buyers are going to place the opposite trades and turn the trend to become what? A sell or a falling what? Trend. So it's important that when the price is overbought, you make sure that you are out. And the same way, when the price is oversold, it simply means that sellers are exhausted and they are leaving, or they have left the sell position, meaning they are taking their trades out, they are closing their sell positions, and as such they will soon be taking a reversal. So it's important that immediately you see that the price is oversold, you should be getting ready to get out from the market and take the opposite position, of course following this simple rule. So basically, this is how stochastic works. So let's just take a wrap up on the stochastic indicator. The stochastic indicator is used to indicate overbought and oversold conditions. That is, when the moving average lines, these lines, are above 80, this 80, for example, here, or here, or here, it means that the market is overbought. So we should start to look to sell. We should start to look for sell position. And on the other hand, when the moving average lines, for example, here are below, let's get better one. Okay, for example, are below 20. This is the 20. So you can see that here the moving average lines are below 20. It means that the market is oversold, and we should start to look to buy. So basically, this is all about stochastic, but the primary function of stochastic is to tell us traders as to whether the market is overbought or the market is oversold. It is not that effective for entry and exiting of trades. That is, it's not too accurate for entering and exiting trades, but it is very, very helpful in terms of telling us as to if the price is oversold or if the price is overbought, and it also tells us to be able to determine or to know whether the trend is going up or is going down. But basically it's just to help us know whether the price of the particular pair is overbought or oversold. It works the same for all the instruments. Let's put this Nasdaq, so it works the same way for all instruments, be it shares, be it commodities. It works the same way, be it indexes and all that. It works the same way. So to delete the stochastic indicator, all you need to do is to put the cursor on this moving averages, right click, and then it will bring you here, and then you click delete indicator, and then it's gone. To get it back, you go to insert, then indicators, then oscillators, then you look for it, and then you find it there in oscillators. So when you come here, this is the stochastic oscillator. The K period should be 5, the slowing 3, the D period 3, the price field low or high, the moving average method simple, and then the fixed minimum 0 and the fixed maximum 100. Once all these things are in place, you click OK, and then you have your stochastic to work with. It is very simple to use, and I believe with patience and practice you will understand and you will use it effectively. Thank you.